Welcome, this is OkGenZ. If you're watching this video, you want to know about investing, you want to know about index funds and so much more. So let's get this video going with my Pikachu t-shirt on. It's only going to be a good one. Alright, what if I told you there is a secret to investing? A secret that the rich have been using for decades, centuries. A secret that will make sure that you are 90% likely to beat the professional traders, the professional hedge funds, and an investment method that is one of the safest and one of the greatest wealth building tools out there. And what if I told you that secret was investing long term into index funds? What if I told you that you could do all of that passively? You could spend the minimum amount of time and you still get the maximum amount of rewards. Sounds too good to be true. But that's what index funds are all about. Okay, so in this video, if you're watching this, you want to know about investments, you want to know how to invest, you want to know what the heck index funds are. And before I begin, I'm going to tell you what funds are. So funds, as a general word, is essentially used to describe a group or a set of stocks or companies. But essentially, imagine if I was to give you £100, $100. You take £100, you invest it into one single company. Let's say Tesla, right? You put it into Tesla. If the Tesla's price of their shares go up, your investments will go up. If the stock price goes down, your investments goes down, crashing like crazy. Now imagine another scenario. I give you $100, £100. You take that money, divide it up into 100 companies and invest £1 into each of those companies. Right now, if one of those companies was to completely go bankrupt, the most you would lose is £1. Right? So the impact of investing in a bunch of companies is that whether you have whether one of those companies goes significantly higher or lower in terms of the share price, it would not affect your overall investment too much. So essentially, instead of putting all your baskets into, instead of putting all your eggs into one basket, you're just spreading them around, reducing the risk, and trying to ensure maximum gains. And that's essentially what a fund is. That's the sort of general fundamental about fund, right? So when we talk about index funds, that's just one type of fund. There are usually three types of funds that are the most commonly spoken about, the ones that are usually the most commonly used. So index fund is one of them, mentioned that. Another one is mutual funds, and the third is ETFs, which are exchange traded funds. Okay, so those are the three types of fund that I'm going to be talking about in this video, so keep watching for more. Let's talk about index funds and mutual funds. They're basically the same thing. Not really, to be honest. But one of the main differences between index and mutual funds is that index funds are passively traded. Okay, they're passively managed. Mutual funds are actively managed. What does that actually mean? So for mutual funds, you put your money towards the fund owner, right? And I'll go through how you do that later on. But let's say you decide to put your money into mutual funds. You take your £100, put it towards a mutual fund owner who manages a fund. And what they will do is they will try and beat the market within their fund by using their fund. Okay, so they'll select companies which will all on average return a higher percentage of returns than the market. And in order to do this, basically they have to do a bunch of analysis, they have to keep changing and improving their fund, the companies that they use for their funds. So it's a fairly effort intensive, right? That's what's called as an actively managed fund, and which is mutual funds. Index funds are passively managed. They don't try and beat the market, they try and match the market. So they're trying to find companies which will do on average about the same as the market. They're not trying to go too high, they're not trying to go low, obviously. Why would you do that? But that's the whole point of index fund. It's just you manage it passively, you pick the companies that are doing generally the best over a certain period of time, and you just put your money, divide it up, put it into those however many companies they might be. And because of this difference of active versus passive, mutual funds, you have to be careful now, is more expensive to buy and to maintain than index funds. Essentially, the fees on mutual funds are higher than index funds because, like I said, mutual funds involves more effort, more time. And because of these higher fees, personally, I would recommend as a beginner, which is what this video is about, is for beginners, you should try and go off the two. Whether if you're deciding between mutual and index funds, you should go to the index funds because it's lower fees. And one thing you have to be aware of is, if you do invest into mutual funds, you might think, well, they're the better option. They're trying to beat the market, so why wouldn't I? Well, so this is where it gets a bit tricky. Even though they try to beat the market, most of the times they don't actually do that successfully. Did you know there was a study done between 2005 and 2015 where a bunch of hedge funds had basically been obviously like doing trading and whatever. The study compared the performance of these hedge funds against the market between these 10 years. The conclusion was 78%, practically 4 out of 5 times the hedge funds did not beat the market. So that's why it's not a guarantee that these mutual funds will beat the market, but you still have to pay these higher fees even if they don't beat the market. So essentially it's a potential win, but really it's unlikely that you will beat the market. And even if you do beat the market, you still have to pay higher fees, so your overall net return will be lower than if you were to get those gains without the higher fees, if that makes sense. Now obviously there is still a way that you can invest into mutual funds and be better off than investing into index funds. And actually, to be fair, we on this channel we spoke about Dave Ramsey, and he actually recommends investing into mutual funds. So it's not a bad thing, but you just have to be aware what you're getting into. So as a beginner, like I said, if it was me, I would put it into index funds. Off the two, lower fees. They're generally trying to just match the market. They're not trying to do anything fancy. And to be fair, even index funds can beat the market. It's not like they won't beat it. It's just not something that they're trying to actively do. So that's kind of the difference between index and mutual funds. And actually, one more thing about mutual funds before I move on to the next topic is that mutual funds sometimes have a minimum investment amount. And it could be a lot, to be honest. The ones I saw when I was researching, the range was a few thousand, a few hundred, up to 5,000-6,000, even more. So that's why if you try and go for some of the sort of high-end mutual funds, they might actually have minimum investment amounts, which means you have to put a bunch of money in to actually be able to invest, which is why I would not recommend it for beginners. But you have an option there. You know what this is all about, so you can make your own decision. And actually, on that note, just I have to say this because as a disclaimer, this is not financial advice. I am not a financial advisor. This is based on all the research I've done, all the experiences I've had over the past with my investments. And yeah, I mean, whenever you make a investment, always do your research, make sure you're aware of the risks, and don't ever invest money that you don't have to lose. Okay, don't ever borrow money to make investments. That's a very risky game. It's not worth it. Don't do it. But anyways, this is not a financial advice. This is merely a way of me providing some reflection on the experiences I've had to do with investments. Okay, next thing we have ETFs. These are my favorite. Okay, ETFs, like I said, stands for Exchange Traded Funds. Okay, what this means is, unlike index funds and mutual funds, you can actually buy and sell these ETF fund shares essentially on the stock exchange. And with mutual funds and index funds, you can't do that. With a mutual and index fund, you have to buy and sell, trade these funds using an actual platform, an actual brokerage platform, such as Vanguard, Fidelity, Charles Schwab. There's a bunch of them out there. But with ETFs, you can actually trade them using brokerage apps such as Trading 212 in the UK, Free Trade. You have Robinhood in the US, which is, it's on a shaky leg, but you have that option, and a bunch of others, Webull, whatever, right? So because of this, personally, this is what I go for. Of the three funds, I personally go for ETFs because I like having the flexibility of just having my phone there and I can just make the trades whenever I want. Obviously, you don't want to be doing day trading style of trading with these funds because that's not what they're there for. They're for long-term trading. Okay, so whether you invest in index, mutual, or ETFs, you have to do it for the long term. You're not going to be gaining much returns out of out of the day trading style of trading, right? Don't go for that. If you want to get started with investing, I will link down below the referral link for Free Trade and Trading 212. If you use those links to sign up, if you haven't already, for new customers only, you get a share for free, I'll get a share for free, so it's a win-win situation. So it's there, you don't have to use it, there's no obligation, but it's just there if you want to use it. Okay, so while we're on this topic, it's important to note that mutual and index funds can only be bought or sold at the end of the day, right? So if you're using, say, Vanguard, right, you buy some index funds, you can only buy them at the end of the day, and you can only sell them at the end of the day. So you can't just trade them during the day, even though the value of the fund might go up or down during the day. Obviously it will. You can't actually buy or sell. With ETFs, you can do that. So say if there's a news breaks out that the technology sector in the US will have the best year in history of investments and in the history of stock market. At that exact moment that the article comes out, you can go and buy some ETFs for the technology sector. But you couldn't do that with index or mutual funds. You'd have to wait to the end of the day and then buy. Okay?
Changing scenery, changing location, but the same old me and the same old Pikachu t-shirt. So, what's happened? Well, this is what happens when you try and record at home without a proper setup during night time when people want to sleep and you have to be moved out of your room because you're too loud and you're just trying to make some decent content. But yeah, here we go. Anyways, how do we put money into these funds? So there's two ways. For ETFs, you can either do it directly with a brokerage app like I mentioned, Free Trade, Trading 212, Robinhood, etc. Or you can invest directly with asset management companies such as Vanguard, Fidelity, Charles Schwab, and a bunch of others. Okay, so to do that, you just go into the website and you essentially navigate to the section of either mutual funds or index funds, whichever you want to get, or even ETFs for that matter, and you essentially scroll through a bunch of options that you can, a bunch of funds that you could potentially get, and you buy them. Really, that's it. Buy them. You give them your money. You're done. You're done. And you're done. That's it. It's as easy as that. Now you know how to invest into these funds, but what should you actually buy? I don't know. Hey, I'm just here telling you what my experiences are and all the research I've done, but honestly, no one can give you the correct answer. No one can tell you that this fund will generate this much return in the next 1 year. It's just impossible, right? People can have estimates, they can have guesses, but no one can tell you for sure. So whenever you invest, make sure to do your own research. Make sure that you are comfortable yourself with what you invest into, because you don't want to be looking back after a year and be blaming someone else for potentially not doing as well as you thought you would do. Right? You need to be aware of the risks, potential downfalls, the potential downsides of investments, and yeah, you need to be ready. There's a general rule on the internet, in general in investment communities, that if you're going into these funds, you should follow the 70-20-10 rule. Right? So the 70-20-10. essentially what it means is whatever amount of money you're going to be putting into these funds altogether, take 70% of that and put 70%, that 70% into the US stock market index, right? So you basically take 70%, you put it towards a fund that tracks the US stock market. Then you take the 20% of your investment and you put that towards international or global funds, right? So basically funds that track companies all across the world, companies that are outside of the US potentially, to give you an overall view of the world economy. Essentially, you take 10% of your investment and you put that towards bonds index. Okay, so basically 10% towards bonds and a fund that tracks bonds, right? So I'll tell you how I work. Okay, I actually divide all my investments into four funds. I don't invest into bonds. Personally, bonds is meant to be there to sort of balance out your portfolio to make it a bit more stable. The returns are generally lower than the other two funds. So stock market, the US stock market, the global stock market generally does better, and it's meant to be there as a safe sort of stabilizing factor. So if you're later on in your stages of investment, then you should put more money into the bonds because it will essentially make sure that you don't lose too much money, that the changes aren't too drastic. But at the same time, if you want to maximize your gains, which is what stage I'm at, then I'm not going to put into bonds. I'm happy not investing into bonds. Okay, and that's a risk I've decided to take, and that's not what you have to do. You do what you have to do, or what you want to do. This is just my personal opinion. So I've had my investment into four funds. First is a fund by Vanguard tracking the S&P 500. So this is basically targeted towards the US stock market. The ticker is VUSA. Right, okay. Fairly standard. It's actually returned quite a decent amount in the past 10 years or so. So that's my US stock market ETF. Then next ETF I put my money into is the FTSE All World, again managed by Vanguard. The ticker is VWRL. Decent returns from their past performances, so again I don't mind putting money into it, and I'll break down how much I put into it later, but those are the two ones. And then another two that I put money towards include the FTSE Developed World, again managed by Vanguard. It's an ETF, and the FTSE Emerging Markets Fund. So for the Developed World Fund, the ticker is VEVE, and for the emerging markets, it's VFEM. As a general rule of thumb, put into your funds the money that you will not be needing for the next 5 years. This is what Dave Ramsey suggests. So as a hypothetical example, say if you're earning £100 a month and you don't need £1 off that £100 for the next 5 years, right? You could lose that £1 and still be fine. It would not affect your quality of life. Then that's fine. You can put that £1 towards these funds, towards investing. Say if you're earning £1 million and I don't know, you have 10,000 of that you just don't need, right? You could be living off of 990,000 and still have the same quality of life than when compared to £1 million. So you can take those 10,000, put it towards the funds each month. It's up to you. You have to decide which level of risk you're willing to take. Personally, I'll show you what I do. So whatever I take home every month, so this is the money I take home after taxes and everything else, I take 15% and I put it towards long-term investment. So this is where I split the investment into four categories, right? So these are all my ETFs. 15%. Okay, so after 30 years of putting £375 per month towards these funds, you will have a whopping £558,884.79 into your total funds invested. Off this, actually, this is where it gets interesting. Off this, you've made a total deposit of £135,000, but you've gained an interest of £423,884.79. So practically in 30 years, you've 4x'd your money. You've taken what you invested and you've times it by 4, which is insane, right? 30 years, whatever you put in, you're timing it by 4. Mad stuff. But this is the benefit of compound, and this is why when people ask when should I put it, should I put it now? Should I wait for when the market goes down? You have to put it now. You have to put the money into these funds right now. Obviously, you have to do your research and you have to be comfortable where you're putting your money. But when I say now, I mean as soon as possible. As soon as possible with a respectably comfortable level of engagement. Okay, don't try and time the market, because if you try and time the market, you might be better off, but realistically, you might be just losing out on the gains. And it's more about the attitude and the behavior and the consistency behind these investments than the actual when should I put the money in, right? So if you put your money in, one strategy I like to do is called the dollar cost averaging, which is basically you take the money that you're going to put into these funds and you invest the same amount of money, and on the same day of the month was the same fund. So if I'm putting say £100 towards the Vanguard S&P 500 fund and I'm putting £100, I will always put that £100 on the same date, let's say the first of the month. I'm not going to change it. I'm not going to time the market. I'm just going to put it when I've committed to putting it. You can even go another step and basically divide the month into 4 payments. So you can just take £100, say, okay, I'm going to put money into this fund 4 times in the month at the start of each week. So basically take £25, you invest it in the first week of the month. Then you take another £25, you put it in the second week of the month. But it has to be on the same day, because otherwise you're just gonna end up messing it up. And I mean, it doesn't have to be that strict as well. Like, you don't have to put it on the same day at the same time. But the general goal is that you don't try and time the market. You just put money in, and you forget about it. You let it go on its own, and after a long period of time, you revel in its absolute marvel when you 4x your money. So yeah, so that's essentially funds, what you should do with them, which one you should buy, how much you should put into it, when you should buy, and have fun. And also, yeah, be careful. Don't put money that you don't have. Don't borrow money to invest. That's not what you should be doing. And yeah, that's pretty much it. And let us know down below in the comments if you have any suggestions on funds that you invest into that you think are amazing, because like I said, I'm also learning, right? So if you tell me there's a fund that's doing incredible for the past 10-15 years, I might just put money into that one instead, right? So you can move it around, but obviously I'm not going to do that on a daily basis. But yeah, if there's a fund that's significantly better than what I currently have and it's aligned to what risk I'm willing to take, then yeah, I don't mind moving. But anyways, thanks for watching. This is OkGenZ. Hope you enjoyed the video, and yeah, give it a like, subscribe if you want to see more of this content, and let us know what sort of stuff you want to see, because yeah, we'd love to make content that people want to see, basically. So yeah, thanks for watching. Bye. Have a good day, good night, good afternoon, wherever you are, and nice speaking to you. Hello.